and welcome to our weekly look ahead at the markets. And first of all, we need to do a recap of what's been quite a tumultuous week in financial markets, particularly here in the United Kingdom. Cash in mind's back a little over a week ago, and we had that mini budget, as it was proclaimed, from the new Chancellor. And that sent markets into something of a tailspin. We saw sterling come off quite sharply in the wake of that, and on Monday morning sterling fell to a record low against the US dollar, down at 103 for cable. We also saw stress in the gilt markets. The UK bond markets were under pressure. We saw heavy selling, and the UK 30-year yield rose above 5% for the first time since 2002, and we saw the 10-year above about 4.5%. So real stress in that market. We saw a lot of pressure on the government, and we saw pressure on the Bank of England. Now, initially, the Bank of England said that it was going to monitor the situation and address it through monetary policy at its next scheduled meeting. And we heard from the chief economist at the Bank of England the following day, saying that the bank would be looking at quite aggressive tightening. And that remark seemed to underpin a bit of sterling strength. It was trading around 106 to 108 kind of level. And then on Wednesday, though, we got pressure in the bond market. So as sterling was stabilising, the gilt market was coming under increasing pressure. Lots of mechanical market structure aspects to do with the pensions industry. And the Bank of England was forced to intervene. Its scheduled plan to start selling gilts was paused, and it's began buying longer dated maturity debt in order to shore up the long end of the interest rate curve, shore up those pensions, and allow the market to recover. That seems to have worked. It's going to continue doing that for a few more days. It's a £65 billion plan, buying long dated maturity debt, while still going down the road of hiking interest rates. Now, it's not really QE. It's been billed as QE, and it is technically, but it's really a short-term policy, and that's the idea at least. So we wait to see whether it works, it continues to work, and whether or not it needs to step in again. But the bank has been laying it down pretty obviously that it is going to be hiking rates, and we heard again from the Bank of England later in the week, as it suggested that it will be going forward with quite aggressive interest rate hikes, and again that helps sterling. So by the end of the week, sterling was actually trading around 112, its highest since the budget. It was back to where it had started. So a bit of a round trip, but we wait to see over the coming days and weeks just how much stress the UK market, the gilt market, and sterling come under from changes in government policy. We're going to hear some more supply side reforms. We're going to hear from the OBR in November, and we're going to hear from the Bank of England, of course, as well. So keep your eyes on the pound and UK markets, which have been under a fair bit of pressure. But it's not the case that the UK is alone here. We have seen a lot of pressure across the piece. We saw big down days for the S&P 500. We saw the US 10-year yield spiking above 4% and then sharply retreating to around 3.7%. So severe market dislocations are taking place, and sentiment is pretty rocky. The S&P 500 fell to a year-to-date low. The German DAX fell to its lowest in 2 years, and the FTSE 100 was almost taking out its March 2022 low, but not quite. Holding up, I think, with a bit of sterling weakness, just holding the line for it. So the picture coming into this week is pretty dicey, you would say. So we're keeping our eyes on, of course, the UK markets, because they seem to be driving some of the action here. But of course, the Fed and the US is the key player in all this. And this week we get the Nonfarm Payrolls report out on Friday. Really, it's a case of good news is bad news for the market, because the stronger the labour market is, the more cover the Fed has to continue raising rates. Really, the Fed will keep raising rates until something breaks. We think that if the labour market starts to crack, then the Fed might start to just ease back off the gas just a little bit. A slew of Fed speakers last week were talking up just how keen they are to keep hiking rates to get a handle, or get a control of the inflation situation. So the non-farm payrolls will be very important this week. We've also got a batch of PMI releases from the major economies, so that will give us a bit of a reading on just how businesses feel about the economic outlook, how activity is faring given all that's going on in the world. And we're going to hear from OPEC. So if you're in the energy market, that's going to be very important. That's on October 5th. we're going to hear from OPEC, and at that meeting we think there's going to be supply cuts being discussed. At the last meeting they agreed to reduce production by 100,000 barrels per day, but there could be a much bigger production cut in the offing. Russia is said to be pushing for 1 million barrels per day worth of cuts, and that's after Brent crude prices fell to their weakest since January last week. We saw Brent down at about $82 a barrel, but it did recover towards the end of the week. It was up back around an 87 mark. So volatile oil markets remain, but prices are a lot lower than they were. Goldman Sachs has had to come out and admit that it got its $140 per barrel call wrong, saying that it misjudged the strength of pricing in local currencies and the effect that that would have on the oil market. So those are the main events coming up next week. Keep your eyes on the UK, keep your eyes on the political situation there, as well as what the Bank of England might need to do.